the European Union has just dropped a bombshell in global trade. In a move that's sending shockwaves across international markets, the EU has officially imposed a staggering 67% tariff on a wide range of Chinese goods. This bold economic strike comes at a time when China's currency, the renminbi, has plummeted to its lowest level against the euro in over a decade. The timing of this development couldn't be more significant, as it signals a deepening rift between two of the world's largest economic powers, and it could have far-reaching consequences for global supply chains, consumer prices, and international diplomacy. The EU's decision to raise tariffs this aggressively is being interpreted as a strong stance against what many in Europe see as an increasingly unbalanced trade relationship. European officials have long expressed concerns that China is flooding the market with artificially cheap products, particularly in industries like steel, electric vehicles, solar panels, and consumer electronics. These products often benefit from substantial state subsidies back in China, making it nearly impossible for European manufacturers to compete. The 67% tariff is being framed as a protective measure to shield local industries from what officials describe as unfair competition. But make no mistake, this is also a political message. Europe is telling China, in no uncertain terms, that it won't tolerate what it sees as economic manipulation. China, of course, has not taken this move lightly. State media has blasted the EU for what they call protectionist and discriminatory policies. Chinese officials are accusing the EU of violating World Trade Organization rules and are threatening retaliatory tariffs of their own. If this tit-for-tat escalation continues, we could be looking at the beginnings of a full-blown trade war between two major players in the global economy. One of the driving factors behind the EU's aggressive move is the continued weakening of the Chinese renminbi. Against the euro, the RMB has fallen to levels not seen since 2014. For European exporters, this makes Chinese products even cheaper and more attractive to consumers, further widening the trade imbalance. European leaders are concerned that if no action is taken, domestic companies across key sectors will continue to lose ground, potentially resulting in job losses, factory shutdowns, and a decline in industrial competitiveness. But this story isn't just about tariffs and currencies. It's also about the deeper geopolitical shifts that are reshaping the world. Over the past several years, the EU has grown increasingly wary of relying too heavily on China for critical goods and raw materials. From rare earth metals to pharmaceutical ingredients, the COVID-19 pandemic exposed just how dependent Europe had become on global supply chains, and particularly on Chinese factories. Since then, there has been a major push within the EU to de-risk and reduce economic dependency on China. This new tariff regime fits squarely into that broader strategy. At the same time, the EU has been under pressure from its allies, especially the United States, to take a firmer stance on China. Washington has already enacted sweeping tariffs and restrictions on Chinese technology firms, and now it seems Brussels is following suit, though some argue the EU is still trying to walk a delicate line between competition and cooperation. For European consumers, the 67% tariff could mean higher prices on a variety of products, especially electronics, green energy components, and automotive parts. Retailers and importers are warning that costs will inevitably be passed on to the end user. While the intention behind the tariff is to protect jobs and industry in the long term, the short-term impact may be a spike in inflation, something the European Central Bank has been fighting hard to keep under control. For China, the fall of the RMB is both a symptom and a cause of deeper economic troubles. The country has been grappling with sluggish growth, a struggling real estate sector, declining foreign investment, and weak domestic demand. As the currency weakens, Chinese exports become cheaper, but that also increases the cost of importing goods and repaying dollar-denominated debts. A prolonged slide in the RMB could shake investor confidence even further and destabilize China's financial system. Global markets have already started reacting. The euro has gained strength, Chinese stocks have taken a hit, and investors are bracing for more volatility. Analysts are closely watching to see how Beijing responds. Will China try to boost its currency through state intervention? Will it retaliate with tariffs on European luxury goods, wines, or autos? Or will it attempt to de-escalate and negotiate with Brussels behind closed doors? The reality is, the global economy is entering a new era, one defined not by cooperation, but by fragmentation and rivalry. As economic nationalism rises across the world, countries are prioritizing self-sufficiency and strategic autonomy over globalization. The EU's 67% tariff is not just a number, it's a clear indicator that the rules of the game are changing. What's at stake isn't just trade flows or profit margins. It's the balance of power in a world that's growing more multipolar by the day. Europe is reasserting itself, China is doubling down on its economic model, and the rest of the world is left watching and preparing for the ripple effects. In the weeks ahead, all eyes will be on the response from Beijing and whether this clash will lead to further decoupling or a costly economic conflict that no one can afford.